Hi, thanks so much for joining in. You're watching the Mutual Fund Show. My name is Alex Matthew. Now, this show gets you actionable insight on everything mutual fund related. And to that end, if you've got specific questions for us, of course, we'll have a topic that we talk about today. But if you've got questions for us, you can send them on the number that you see on the bottom of your screen. Today, we're going to be talking about an infrastructure theme, because this is really something that a lot of people have focused on in the recent past. And to talk about it, I'm joined by Mahesh Patil, who's the CIO of Aditya Birla Sun Life AMC. Mahesh, thanks so much for joining in. It's interesting to talk to you about infrastructure because you've been managing an infrastructure fund for, I think, perhaps one of the longest in the industry. 2006, if I'm not mistaken, is when you started managing this fund. But before I get to that infrastructure space, while we're talking about the markets, it would be remiss of me not to ask you how you're seeing the current trends pan out. We're seeing a lot of retail investors deploy through lump sum route, and we're also seemingly seeing mutual funds deploy as well. How would you describe the current scenario?
Yeah, good afternoon. And yeah, so I think specifically on the market per se, I think we have seeing some now a period where there has been, general weakness, right, in the last couple of months, while the index has corrected a bit, but the broader market has seen a much bigger correction. There are many stocks which are down like 20-30%, right, from the recent highs at this point in time. So I think this is a period where there is, obviously there's a huge amount of selling what we've seen from the FIs in the last month or so, and that is putting some pressure. But I think equally we have seen that the earnings growth also has, for the last 2 quarters, we have seen that has slowed down. There have been some disappointments, across sectors, I would say, including on the consumer side, and that is really impacting the market, I would say. And in terms of the flows, I think the good thing is that the mutual fund flows are still fairly strong. So that is to some extent supporting the market despite the large onslaught of FI selling what we have seen. So I would guess that the market is trying to now find some kind of a support. Okay, it is trying to adjust to the quarterly numbers, okay, which have come in, and also to the slight slowdown in the earnings momentum, or what we had seen in the last 2-3 years, which was very strong. So it is coming at levels, especially the Nifty and the large cap names are coming to a level which are looking attractive, okay, where it is good, I would say, investors to come in and buy into this dips.
Note, let me ask you where you're seeing value as well, because we're asking portfolio managers, we're asking fund managers to talk about this, and some of them are still a little wary. Some of them have said that the cash calls that they had taken, they're not entirely turning them around, they're not deploying whole hog. What has your approach been?
So if you ask me value, if you look at the market, if you look at the Nifty, right, and look at where it is. So the Nifty multiples are now similar to what it was pre-COVID levels, right? We are somewhere there on a one-year forward basis, and clearly looking at the fact that the overall market or the macro economy is much better than what it was pre-COVID. It would mean that that there is clearly some value which is emerging into the large frontline names, okay, which have corrected at this point in time. And apart from that, I would say, amongst the sectors, I think some of the good quality consumer names, okay, they have seen a correction because this quarter has been weak. And so clearly there is some amount of, in some of the high quality names, we are seeing reasonable value which is emerging, though the outlook there might not improve immediately in the next 1 or 2 quarters. But if you take a 3-year view, some of the good quality names on the consumption side are looking good over here from a valuation perspective. Also, the banks, if you look at the banking and financials, that's again a sector where it has underperformed because of the regulatory action from RBI, what we see, and the overall credit growth slightly slowing down. But if you look at purely from a long-term valuation perspective, I think they are at reasonable levels. Again, there has been some amount of because of the tightness which has been there in the system. The deposit growth has been weak, but I think as RBI eases off, I think liquidity, I think you will see that kind of normalizing. So I think these are the areas where I think one would probably say that the value is uh, kind of emerging at
Okay.
these levels. Or probably, I mean, the Nifty another 2-3%, 3-4% down would really start to look fairly attractive.
Understood. Understood. All right. So I've kind of gotten a sense of where you see value emerging as well. But let's talk about infrastructure. And we're talking at a time when you're just about to launch a new fund offer for an index fund in the infrastructure space. And I'm curious what the thinking here is, Mahesh, because you've been running an infrastructure actively managed scheme that has done quite well for itself since 2006, and an index fund would be a very different approach. So first, let's talk about the thinking behind that.
Yeah, so I think we run both. I mean, the active fund also, and we have passives also, the index fund, right, which are kind of trying to do justice because in a actively managed fund, you will have a fund manager like myself, okay, having their own biases, okay, and sometimes we've seen that you try to over emphasize or you have your own biases in terms of to what extent, especially on valuations. And when there is a strong momentum, okay, which is there driving, but fund investors would want to play that theme, right? So infra is a kind of a theme which has done very well in the last 2 years. We've seen the especially on the government CAPEX side, which has aided the infra companies. But we think that this theme has still got a longer runway to go, right? Especially with now the private sector CAPEX likely to improve, okay, in the coming years. We think that the things are poised now for private CAPEX to pick up, looking at the corporate balance sheets, and also considering the fact that the overall capacity utilization levels are now reaching a level where CAPEX should pick up. Again, on the infra side, also, I think if you look at the overall investments on the railways, there has been a big increase by the government in the last few budgets, especially on signaling and in terms of track laying. Power sector has actually surprised us in a big way. I mean, we've seen this sector in the last 1 year. The government has revised its target upward by around 3 times, right? In terms, especially, I mean, renewables is one area where now from 150 gigawatt, we're looking at almost like 300 gigawatt of renewables, okay, by 2030, incremental capacity creation, which is almost double in terms of target what it was a year back. And the thermal capacity, which we thought is kind of a sunset, but that has also seen revised because if we don't do that, we'll have peak shortages. So again, the power sector, the power transmission distribution sector is now again coming back in terms of large capex over there,
Point taken.
and
So, so,
yes. So I
so,
think given that,
yeah.
I just have to conclude. So I think if you look at our infra fund and the actively managed, it is slightly more diversified, whereas the infrastructure passive fund, what we have, which is purely focusing on the infra space, right? Our active fund will also have some exposure to banking and financial because that's the nature of what it is. This is a pure fund focusing only on the infra theme.
Okay. Yeah, and that's exactly what I wanted to ask you, because as somebody that has looked at this space over the last 2.5 decades, would you say, therefore, in 2024 and heading into 2025, we're poised, obviously, as you pointed out, for significant growth in the space, even from this point on, but the dynamics are entirely different, because today, for example, if you're talking about a PFC, REC, and the kind of loan growth that they're envisaged to have, would you say that the way to play the infrastructure theme is a combination of pure play infra plus the lenders and not the traditional lenders at that?
Yeah, I would say, yeah. I mean, if you really want, because normally when investors come into the passive, right, they want to play a clear theme, right? They don't want to, whereas in active fund, you try to balance it out a bit in terms of the risk. So it is Clearly, I think on the passive side, it is unadulterated, pure core focusing on the theme, and it's pretty well defined, right? You know the index, right, where it is. Okay, what is the concentration there in at the stock level, as well as the sectors where it is investing into. So in that sense, it also to some extent increases the risk also. But clearly, for an investor who wants to play that theme and if is positive on that, I think it makes ideally to come in through the passive side. And the fact that we believe that while infra has been now talked about for some time, I think there is still a long way to go for India. Okay, where we need to. It's a growing economy. I think we are still underserved on infra, whether it's on the roads. We have seen a good improvement over there, but the next leg of growth is likely to happen, and which will continue for the next 5 to 10 years or so. So I think given that, I would say that it is, I mean, a concentrated portfolio with clear kind of allocation to a few sectors would make a lot of sense for investors who want to really play some of these sectors, whether it's in the power sector, it's in the railway sector, in the road sectors, or in the transmission and distribution and the logistics space, which
Yeah.
is all the themes which you can play through this fund.
Yeah, fair point. We're also, and the last point that I want to raise with you, we're also anticipating that CAPEX in the second half will be more from the government side. And so to that end, there's expected to be some more in action in the way of earnings growth. But where do you see it in the next 3 to 5 years, the earnings growth in the infra space?
So you're right. I think one is clearly, I think the government spending, which was undershot in the last first 6 months of this year because of elections. I think that will get accelerated, and that would lead to, I think, better order inflows for the companies in the infrastructure sector. And I think that's again a good entry point as the order book builds up. But if you take a slightly longer term view, I think we think that a power sector clearly is an area where the investments are going to be significantly higher, both in the renewables, which is the solar as well as wind. And also there are other renewable like pump storage where there is a big target, okay, which is there. And that would mean that the whole value chain in the power sector, equipment side, the transmission and distribution space will also see a good growth. Mind you, globally also there is a strong demand for power equipment because of the demand for power now coming in from alternative sources like data centers, AI. There is a kind of a shortage of power equipment, which is also favor Indian companies, okay, which have been increasing capacity and putting that capacity in place. Apart from the power sector, I would say the logistics sector is another sector which is kind of emerging, and India is now focusing on trying to reduce the logistics costs, and there's a large investment which will happen in that space. And then the whole CAPEX recovery, private sector CAPEX, is which is probably its early stages of its recovery, which up till now it has been the government sector which has been driving the whole CAPEX. Now it's the patent to take on to the private sector, which I think would be another theme which will, I think, will play out over the next 3 years.
Interesting. All right. Thanks so much, Mahesh, for joining in, for giving us that perspective, and pleasure having you on the show.
Thank you.
All right, let's get in Anant Ladda, who's the founder of Invest Aaj for Kal, now to talk about the space as well as what investors have been doing. Anant, thanks so much for taking the time and for speaking to us in the Mutual Fund Show. I was looking at some data for the month gone by, and actively managed equity mutual fund schemes have seen inflows of over 40,000 crore rupees on a net basis. Quite a chunk of that, once again, going to sectoral thematic. And what we're talking about essentially right now with Mahesh is essentially a sectoral and thematic play. There is also data that suggests there are a lot of lump sums going in. And if an investor wants to try and buy the dip, in your opinion, is it through doing it in this tactical manner, and how should one go about it?
Hi, Alex. Firstly, thank you so much for having me on the show. Always fun discussing important topics with you. See, let me try and divide our conversation in different parts. Firstly, let me talk about what can be the strategy of an investor who is regularly investing in mutual funds and want to participate in this dip. There can be two strategies. Firstly, you can double down your SIPs if you have regular flows. You can probably double down your SIPs for next few months, and till the time market is below its 50-day moving average, or roughly you can say till the market is below the range of 24,600, 700, you can probably double your SIP amount per month, so that you are buying extra units when market is down. Secondly, if you have a lump sum amount, for example, you are doing SIP of 10,000, but at the same time you have 1 lakh rupees additional in your kitty and you want to invest it, then probably you can divide that amount in 10 parts. And presently, you can start investing 1/10 of the part immediately. And subsequently, on weekly basis, you can keep on putting that amount, so that you are buying at a gap also, and you are utilizing this complete dip, and you are not having FOMO also, because you are properly spreading out your money. Whatever you're investing right now, mindset should be minimum 3.5 to 4 years. I think even 3.5, 4 years will be good time horizon from here on. When we talk about sector funds, firstly, a lot of investors are feeling quite attracted towards them, because if you are right, you make a big fortune and get a big alpha. But at the same time, we have to understand that in last 4 years, market has only gone up. We have not seen major drawdowns in the market. So that is why every call you have made is absolutely right. But when we see market jerks, probably sector funds can be a two-edged sword, and if you don't know the risk, you can take a big hit. So if you're a new investor, fresher, I would suggest to go in a well diversified multi-cap or flexi cap fund. But if you know the risk and you are taking a tactical call, then probably you can go for sector funds.
Yeah, it's a fair point. How would you define a drawdown, though, Anant? I'm just curious, because at this point we have a pullback, if I'm not mistaken. It's not yet, or maybe just a little bit more than a pullback, closer to a correction, about 10% from the all-time high.
See, I was just checking out the data of S&P from 1929 till date. So if we check out by percentage, almost 95% of the years we see a pullback of 5% or more. 63% of the years we see a pullback of 10%, and roughly 25% of the years we saw a pullback of more than 20%. Right now, we are in the range of 10%. Will it go above 10% and move towards 20% drawdown? Probability as per history is 25%. So you can probably use this data and decide how much you are ready to take a hit in your portfolio.
Okay, all right. Interesting data there. Anand, what do you say specifically about this index fund, though? The NFO opens tomorrow, and you've already made your point on sectoral and thematic. And I know that you love cricket analogies. If you're going for the six and you miss, unfortunately, usually if you miss, the bowler normally hits. And in this case, you're losing money.
See, if we talk about infra as a segment in India, specifically government is also quite focused on infra. We saw a bumper budget allocation of 10 lakh crores. Then we saw a 10% increase in that allocation. So as far as that analogy is concerned, obviously India is focused on infra. And whichever country is in a journey from shifting from developing economy to developed economy, infra segment is always in focus. But at the same time, whatever news, whatever data you have, I have, everyone have, and market has already discounted it. What new do we have? That is a big key. And if you think that going forward also you will get better triggers in the budget or maybe better allocations from the government, and it's your strong call that infra will continue to do really well, probably you can do some SIPs or some systematic top-ups in this theme. If you are not well versed with the sectors, if you are not well versed as an investor, if you're a new investor, I would strongly suggest to stay away from any sector funds for that matter. I'm not talking about infra as a sector, any sector funds, and probably take a more diversified view. For example, if you are very aggressive on banking and infra, you can probably choose a fund which is overweighted on these segments. So that might be a better strategy, better way to go about it. But if you know the risk, if you know the upside, if you know the downside risk, and then you are taking a risk, then I would say that you are trying to hit a six on a free hit ball. So that's absolutely okay.
Okay, all right. I like that you turned to the analogy at the end. I've got a couple of questions that have come through from our viewers, Anand, and I'll take a couple of them to you. Manasvi, who's 26 years old, has been looking at Navi mutual fund. And she's looked at the expense ratios and she said that they are among the lowest that she has seen. And that's but natural, right, Anand, because they play in the passive space. She's asking, is it a reliable fund house? What would you say?
See, if you are investing in an index or a passive fund, every fund house is almost same. Usually their expense ratio is more or less the same. We need to see at the tracking error, which is also uh, in the respectable range. So won't make much of a difference. And I feel you should not get stick to any fund house name or any fund name. You should look at other data and your own risk profile and then take a call. But as such, it's a reliable fund house. Obviously, it's a reliable fund house. And since it is dealing in indexes, I don't see any issues as far as that is concerned.
That's a fair point. One more question that I'll take to you. And this is a pretty general question, Anant. Arbaeen Kazmi, who's 57 years old, and I think the age is important to factor here, has saved up about 2 lakh rupees over the course of the last couple of years and would like to invest that amount in mutual funds. What funds would you recommend that you divide this into? Not specified what the duration is, but let us assume that we're talking about more than 3 years here. Anant, very clearly more than 3 years. Arbaeen is 57, so at the age of 60, what kind of funds should Arbaeen invest in?
See, looking at the risk profile and the basic limited data which we have, looks like this amount is important for retirement corpus and it'll play an important role. So looking at that thing, we cannot invest 100% in equity. Firstly, some part of the allocation should be made to debt funds or maybe FD for that matter. FD is also okay, but if you are comfortable with long duration debt funds, probably you can choose a debt fund in the duration of 3 to 6 years for that matter. Next, second allocation has to be made to balanced advantage funds. Probably a combined allocation of debt and balanced advantage can be in the tune of 60%, and balance 40% can be systematically invested in equities, because even after retirement, we would be wanting to beat inflation and get at least a 10% CAGR returns. And to get that, obviously, we need to invest in equities. We would avoid investing in small cap and mid caps, but probably flexi caps, large caps, and multi cap would be the category to go about it.
Any funds that you like, Anant? Not recommendations, but very quickly, funds that you like in the space that you mentioned?
See, I would just from a very rough portfolio. For example, you can invest 30% in Gilt. Gilt, you have good options in Kotak and ICICI. They have good experience in managing durations. If you go about, if you talk about BAF category, probably DSP and Sundaram both are doing well and they are consistent, low volatile performers. And in equities, a combination of index fund, which is equal weighted, for example, Nifty 50 index fund, and some multi-cap funds would be a perfect choice. In multi-cap, you can select funds like White Oak Multi-Cap. That's a decent fund, which is having a decent performance. And that's it. I think 4 funds would be more than enough.
Absolutely. Thanks so much, Anant, for laying that out. And that last answer, I'm sure, will be beneficial to a lot of people as well. Thanks so much, as always, for joining us on the Mutual Fund Show. All right, that brings us to the end of this particular edition of the Mutual Fund Show. There's lots lined up over the course of the day, so I'd encourage you to stay tuned. This is NDTV Profit.